Somewhere in a suburb outside Dallas, a married couple sits down on a Sunday night to look at their bank account before the new month begins. Between them, they bring home just over $140,000 a year. He works in logistics management. She works in healthcare administration. They own a house. They drive two paid-off cars. On paper, they are the success story their parents hoped for. And yet, by the time the mortgage, the health insurance premium, the daycare invoice, the car insurance, and the minimum payment on a credit card they opened during a slow month have all cleared, there is less than $300 left before the next paycheck arrives. They are not behind on anything. They are not in crisis. They are simply, quietly, out of room. That feeling has a name now, even if most people who feel it have never said it out loud. It is the sensation of doing everything a stable American life was supposed to require and still not feeling stable. For decades, $100,000 a year was the number Americans used as shorthand for making it. It was the six-figure milestone, the number a parent might mention with pride, the number that used to separate a comfortable household from an anxious one. That number has not disappeared, but its meaning has. A survey of Americans earning between $100,000 and $250,000 a year found that roughly 4 in 10 of them described themselves as living paycheck to paycheck. Separate research on six-figure earners specifically has found similar numbers, often approaching 40%. These are not people who are poor by any conventional measure. They are people whose income has stopped translating into the sense of security that income is supposed to buy. This is a story about that gap, not the gap between rich and poor, which has existed for a long time and has its own explanations. This is the newer, stranger gap between income and security, appearing inside a group of Americans who assumed they had already crossed the finish line. To understand why $100,000 no longer feels like it used to, it helps to follow the money the way a household actually experiences it, rather than the way a headline reports it. Start with taxes, because that is where the number starts shrinking before a single bill gets paid. A single filer earning $100,000 faces federal income tax brackets that take a meaningful bite once the standard deduction is applied, along with Social Security and Medicare taxes that come out regardless of state. Depending on where that person lives, state income tax takes another share. By the time all of that is finished, a considerable portion of the original number has already left the picture. Before rent, before groceries, before a single decision has been made about how to live. What remains has to stretch across a set of fixed costs that have moved much faster than income over the last several years. Housing is the clearest example, and it is worth being precise about it, because the precision is what makes the story credible rather than dramatic. Nationally, a household now needs to earn somewhere in the range of $107,000 to nearly $117,000 a year to comfortably afford the mortgage on a median-priced home, depending on which analysis you consult and which month's mortgage rates and home prices it uses. The national median household income sits meaningfully below that line, somewhere in the low 80s of thousands. That means the household earning exactly $100,000 a year, the number that used to represent comfortable arrival, now sits below the income threshold required to buy the median home in the country where they live. In some metro areas, the gap is not subtle at all. In parts of California, the income required to buy a median home exceeds $300,000. In Boston, the required income has nearly doubled in 5 years. In cities considered relatively affordable like Houston or Dallas, a six-figure salary still goes further than it did last year, which is genuinely good news. But it is good news measured against a recent low point, not against the expectations of 20 years ago. For homeowners who already have a mortgage, the picture looks different, and this is one of the places where the story needs real nuance rather than a single dramatic conclusion. The median monthly mortgage payment across all existing homeowners with a mortgage is close to $1,600, and for many of those households, that represents a very manageable share of income, often under 20%. Homeowners who bought years ago before rates rose are in a genuinely different financial position than families trying to buy today. That is an important distinction, and it explains why this story does not affect every household earning six figures equally. It explains why some of the loudest complaints about affordability come from people who are actually doing reasonably well by historical standards, while some of the quietest suffering happens among people who look, from the outside, like they are doing fine. The households under the most pressure are not always the ones who already own a home with a low, locked-in payment. They are often the ones trying to become homeowners for the first time in their 40s or 50s, after years of renting, hoping to finally build equity before retirement. They are the households who sold a starter home during the pandemic at a good price, only to discover that a comparable next home now costs far more to finance than the one they left, because the rate on the loan matters as much as the price of the house. They are the two-income households who assumed that combining two respectable salaries would put homeownership within easy reach, only to find that in most states, the income required to buy a typical home now exceeds what the typical household actually earns. Housing is the largest fixed cost, but it is rarely the only one doing the damage. Health insurance is the second major force quietly eating into that six-figure number, and it operates differently than most people expect. For workers with employer-sponsored coverage, the average worker's own contribution toward family health coverage has climbed to roughly $6,800 a year, and that figure has been rising by mid-single-digit percentages annually, faster than most paychecks. That number covers only the employee's share of the premium. It does not include the deductible, which for many plans runs into the thousands of dollars before the insurance meaningfully starts paying, and it does not include the co-pays, prescriptions, or the unplanned specialist visit that arrives the same month as a car repair. A household earning $100,000 a year can be fully insured and still be one significant medical event away from a financial setback that takes a year or more to recover from, simply because the deductible and the premium contribution together can approach $10,000 annually before any real benefit kicks in. Then there is childcare, which for households with young children can be the single most destabilizing line item of all, precisely because it does not shrink, delay, or become optional the way a vacation or a renovation can. The national average cost of full-time center-based care for one child is now somewhere between $13,000 and $15,000 a year, and infant care in particular, because of stricter staffing ratios, often runs higher, sometimes exceeding $17,000 annually. In expensive metro areas, that number climbs well past $20,000 for a single child. A family with two children under 5, both in center-based care, can be paying more for childcare than for their mortgage. The federal government defines affordable childcare as costing no more than 7% of household income. By that standard, center-based infant care is not affordable in a single state in the country. For a household with 2 working parents and 2 young children, it is entirely possible to earn $140,000 or $150,000 a year and still find that, once childcare is paid, the second income barely covers its own cost of existing. This is where the arithmetic starts to reveal something more interesting than a simple list of expenses. It reveals a structural problem hiding inside a number that still sounds impressive. A household can be earning genuinely more money than most Americans and still be operating with almost no margin, because nearly every dollar of that income is already claimed before it arrives, by a mortgage or rent payment calculated against yesterday's home prices, by a health plan priced against yesterday's medical costs, and by a child care bill priced against a labor market that has never had enough workers willing to do that job for what centers can afford to pay them. The income is 6 figures. The obligations are also, in effect, 6 figures. What used to be called a comfortable salary has become, in a meaningful number of households, a break-even salary with a good address. Consider a household that represents this pattern without being any one specific family. A couple in their late 30s, combined income around $130,000, 2 children, 1 in daycare, and 1 in early elementary school. They bought their home 5 years ago at a rate that today looks almost enviable. On the surface, everything about their life photographs as success. Then one partner's department is restructured, and the job that pays $60,000 of that combined income disappears. The mortgage does not change. The health insurance, if it was tied to the job that was lost, either becomes far more expensive through a program that extends coverage temporarily, at close to full price, or requires an urgent scramble to find a new employer plan before a gap in coverage exposes the family to real risk. The daycare bill does not pause for a job search. For the first month, savings absorb the shock, because most financially disciplined households do have some savings. By the 3rd month, a credit card is covering what savings no longer can. By the 6th month, if a new job has not been found at a comparable salary, that credit card balance has become a new fixed monthly cost of its own, with interest that did not exist in the family's budget a year earlier. The dental visit gets postponed. The car repair becomes a temporary patch instead of a proper fix. The family does not become homeless. They do not appear in any dramatic statistic. They simply become quietly, permanently behind, in a way that a strong resume and a six-figure job title never prepared them to explain to anyone. That is the version of financial insecurity this income bracket actually experiences most often. Not collapse, erosion. And erosion is harder to see, harder to talk about, and in some ways harder to recover from, because there is no single dramatic event anyone can point to as the cause. It helps to pause here and be honest about something the data does not let anyone avoid. Not every household earning $100,000 a year is struggling for the same reasons, and some of what looks like structural pressure is, in fact, a choice. A household that stretches to buy a larger home than it needs, finances two new vehicles instead of driving older paid-off ones, or maintains private school tuition while also complaining about the cost of groceries is carrying a burden it created for itself, and no economic trend forces anyone to make those choices. It would be dishonest to pretend that every six-figure household living paycheck to paycheck is a victim of forces beyond its control. Some of it is lifestyle. Financial researchers who study this exact bracket point out that lifestyle inflation, the tendency to expand spending in step with a raise rather than banking the difference, plays a real role in why a rising number of high earners report no financial cushion. But that honest acknowledgement does not erase the other half of the picture, and the other half is where this story actually lives. Because underneath the discretionary spending, there is a layer of cost that has nothing to do with lifestyle at all. Housing near a person's job is not a luxury. Two working parents needing childcare so both incomes can exist is not a luxury. Health insurance is not a luxury. Property taxes rising because a county reassessed home values are not a luxury. These are the costs a household cannot cut its way out of by making coffee at home or canceling a streaming subscription. A family can eliminate every discretionary expense in its budget and still be underwater, because the fixed costs alone, in a growing number of American zip codes, now exceed what a six-figure income can comfortably absorb. There is a second layer to this story that goes beyond the household ledger, and it involves something less visible than a mortgage statement: the loss of mobility. Homeownership has always been sold as the foundation of financial freedom in America, the asset that lets a family build equity, move up, and eventually move on. For a growing number of homeowners, it has become the opposite. A couple who bought a starter home at a mortgage rate under 4% now finds that moving to a larger home, even one that costs the same or only slightly more, would mean financing at a rate that could be a percentage point higher, sometimes several. The monthly payment on a comparable home can jump by hundreds of dollars simply because of when the loan was taken out, not because of anything the family did wrong. The result is a phenomenon housing economists have started calling lock-in. Families stay in homes that no longer fit them, too small for a growing family, too far from aging parents, too expensive to insure in a changing climate, because the alternative, trading a low fixed rate for a market rate, would cost more than staying put ever could. The home that was supposed to represent security has become, for some households, a kind of trap with good equity and no exit. Property taxes compound this in places where home values have risen sharply. A retiree on a fixed income, or a household whose salary has grown more slowly than local real estate, can watch their property tax bill climb year after year on a home they have owned for decades, sometimes forcing a choice between staying in a paid-off house that has become unaffordable to maintain and selling a home full of memories simply to escape a tax bill. Insurance adds another layer in regions facing more frequent flooding, wildfire, or severe storms, where some homeowners have seen premiums double or, in the most severe cases, lost coverage entirely and been forced onto expensive state-backed insurance plans of last resort. None of this shows up in a simple description of a six-figure salary. All of it shows up in what that salary actually has to cover. This is the point in the story where the initial question deserves a second look, because the honest answer is more complicated than the first one. The problem is not simply that $100,000 buys less than it used to, though that is true. The deeper problem is that a growing number of American households have built a life with almost no margin for anything to go wrong, and they built that life around an income that itself is not guaranteed to continue. It is not just that things cost more. It is that the income side of the equation has quietly become less secure at the very moment the expense side became less forgiving. Consider what income stability actually looks like for a person earning around $100,000 today compared to a generation ago. Many of these workers are in mid-level professional or technical roles, precisely the kind of positions now being reshaped by automation artificial intelligence tools, and corporate restructuring aimed at doing more with fewer salaried employees. A worker in their late 40s who loses a role at this income level does not face the same job market their parents faced. Age can work against them in a hiring process that, however illegally, still favors younger and cheaper candidates. Skills that were valuable 5 years ago can be devalued by new software faster than a worker can retrain. And crucially, in the United States, health insurance is still overwhelmingly tied to employment, which means a job loss is never only an income loss. It is simultaneously a healthcare crisis waiting to happen, arriving at the exact moment a family can least afford one. This is why so many financially comfortable-looking households report having almost no emergency savings. National surveys on financial resilience have consistently found that a large share of American adults, cutting across income levels, would struggle to cover an unexpected expense of even a few $100s using savings alone. It is tempting to assume that pattern belongs only to lower-income households, but the data does not support that assumption. A meaningful share of it belongs to households earning well over $100,000 a year because their fixed costs consume so much of their income that there is simply nothing left to set aside, regardless of how much they earn on paper. There is a psychological cost to all of this that rarely gets discussed alongside the financial one, and it deserves its own space in this story rather than a passing mention. Imagine being the person in that Dallas area household, the one with the healthcare administration job and the logistics management job, the paid-off cars and the nice-enough house. Imagine being asked at a family gathering how things are going, and hearing yourself say fine, because admitting otherwise feels almost shameful when your income sits comfortably above the median. There is a particular kind of isolation that comes with financial stress at this income level because the culture around you assumes that a six-figure household has no right to struggle. Complaining about money on that income can feel, even to the person doing it, like an embarrassing failure to manage what should be more than enough. So people go quiet. They keep the lawn mowed, the car washed, the kids in the activities their friends' kids are in, and they never mention that the grocery budget has been quietly cut, that the family vacation was paid for on a card that has not been paid off since, or that the couple has stopped talking about a third child because they have done the math on daycare and the number does not work. This silence has real consequences. Financial researchers who study marital conflict consistently identify money as one of the most common sources of tension between partners, and that tension does not disappear simply because the household income looks respectable on a loan application. In households at this income level, the conflict often centers not on whether there is enough money, which would at least be a shared, visible problem, but on why the money that clearly exists never seems to be enough, which tends to produce blame instead of solidarity. One partner wonders if the other is spending carelessly. The other wonders if working this hard was supposed to feel this precarious. Neither partner is entirely wrong, and neither is entirely right, and the argument rarely resolves anything, because the actual cause is structural rather than personal. For Americans in the older end of the audience this channel speaks to, roughly 45 to 75, this story carries an additional layer that younger earners do not yet fully feel: the sandwich generation experience, in which a person is financially responsible for people above and below them at the same time. A worker earning $110,000 a year might be helping an adult child who cannot yet afford rent on their own income, while also beginning to notice that an aging parent's medical needs, transportation needs, or eventual care needs are going to fall, at least partly, on them. This is not a rare or unusual situation. It has become common enough that researchers gave it a name years ago, and the pressure it creates has only intensified as housing costs have pushed young adults towards staying home longer, and as the cost of professional eldercare has climbed beyond what many aging parents can afford on Social Security and modest savings alone. A household with a six-figure income can be simultaneously subsidizing a 26-year-old's rent, contributing to a parent's medication costs, and still trying to fund its own retirement, and something in that arrangement almost always gives, usually the parent's own future security, because it is the only piece of the puzzle that can be quietly postponed. Geography changes this story significantly, and it would be dishonest to describe $100,000 as though it means the same thing everywhere in the country, because it does not. A household earning that amount in a place like Houston or Dallas, where cost of living adjusted analyses show a six-figure salary actually going somewhat further than it did just a year or two ago, is in a meaningfully different position than a household earning the same salary in Manhattan, where the same income, after taxes and cost of living, has been calculated to be worth less than $30,000 in real purchasing power. That is not a typo, and it is not an exaggeration. It is the conclusion of an annual financial analysis that adjusts six-figure salaries for local taxes and cost of living across dozens of American cities, and Manhattan consistently ranks as the place where that number is worth the least. Boston, San Francisco, San Diego, and Los Angeles are not far behind. In some of the country's most expensive metro areas, a household would need an income of $200,000 or more just to afford the median home, which places six figures in an entirely different category than it occupies in a mid-sized southern or midwestern city. This regional gap explains why the phrase $100,000 a year can produce two completely different emotional reactions depending on where the person hearing it lives. In one part of the country, it still buys a real margin of comfort. In another, it buys a studio apartment and a long commute. National statistics tend to flatten this difference into a single misleading average, when the honest picture is closer to two separate economies operating under the same currency. Generational timing matters just as much as geography. A homeowner who bought 15 or 20 years ago, before the sharp run-up in home prices and before mortgage rates rose from historic lows, is often insulated from much of what this story describes, because their single largest fixed cost was locked in years before the pressure began. A worker earning $100,000 today, trying to buy a first home for the first time, faces none of that protection. They are entering the market at its most expensive point in modern history relative to income, competing for the same homes as buyers who already have substantial equity from a previous sale, financing at rates far above what an earlier generation ever had to consider. This is part of why the frustration expressed by younger professionals earning what should be considered a strong income so often collides with the disbelief of older relatives who remember when that same number felt like arrival rather than merely survival. Both experiences are real. They are simply describing two different economies, separated by timing rather than effort. Faced with this pressure, households and the systems around them have not been passive, and it would be inaccurate and unfair to describe this story as one of pure helplessness. People are adapting, and some of those adaptations genuinely help, even if none of them fully solves the underlying structural problem. Some families are relocating deliberately, trading a coastal metro for a smaller city where the same income functions like a much larger one, accepting a different climate, a different social network, and a different pace of life in exchange for a mortgage payment that does not consume a third of their take-home pay. This works, but it is not available to everyone. It requires a job that can move with the person or a willingness to change careers, and it often means leaving aging parents, established friendships, and children's schools behind, a genuine cost that rarely appears in the spreadsheet comparing cost of living between two cities. Other households are turning to multi-generational living, not as a last resort, but as a deliberate financial strategy. An adult child moves home after college instead of renting immediately, not out of failure but out of arithmetic, saving toward a down payment that would otherwise take twice as long. A widowed parent moves in with an adult child's family, consolidating one household's housing costs instead of maintaining two separate homes, while also providing built-in childcare that can offset thousands of dollars a year in daycare bills. This arrangement, once viewed in American culture as unusual or even as a sign of failure, has become common enough that home builders have begun designing houses specifically for it, with separate entrances and small attached living spaces for a parent or adult child. It solves real problems. It also creates new ones around privacy, autonomy, and the friction of merging households that were built around different habits and different decades. Some families are restructuring debt or refinancing where they can, though this option has narrowed considerably for households that locked in low mortgage rates years ago and now have little financial incentive to refinance into anything higher. For renters and recent buyers, refinancing can offer modest relief when rates fall, but it does nothing for the underlying price of the home itself, which in most markets has not meaningfully declined even as rates have shifted. Employers, in a smaller number of cases, are responding to childcare costs directly through backup care benefits, dependent care flexible spending accounts, or on-site care in industries competing hardest for skilled workers. These programs help the employees who have access to them, but they remain the exception rather than the rule, concentrated in large corporations and highly competitive industries, unavailable to the majority of American workers whose employers do not offer anything beyond a standard health plan. State and local governments have experimented with property tax relief programs for long-term homeowners, first-time buyer assistance, and childcare subsidies, and in places where these programs are well-funded, they make a genuine difference for the families who qualify. But they are patchwork by design, varying enormously from one state to the next, means tested in ways that often exclude exactly the six-figure households described in this story, because on paper, that income looks too high to need help, even when the local cost of living tells a different story. None of these responses is a complete solution, and it would be misleading to present any of them as one. Relocation solves housing cost but can fracture family support networks. Multi-generational living solves cost but tests relationships. Refinancing helps only the households positioned to benefit from it. Employer benefits help only the workers whose employers choose to offer them. What all of these adaptations share is that they are individual households absorbing a structural problem, one difficult decision at a time, because the alternative, waiting for housing supply, healthcare costs, and childcare markets to fundamentally rebalance on their own, has not happened yet and shows no reliable sign of happening soon. There is a broader consequence to all of this that extends beyond any single household, and it shows up in the kind of ordinary economic activity that used to define a comfortable middle-class life. When a meaningful share of six-figure households have no real financial margin, they stop doing the things that margin used to pay for. Kitchen renovations get postponed indefinitely. A family that once ate at a local restaurant twice a month now does it twice a year. A vacation that used to be an annual expectation becomes a once every few years event, planned around a tax refund rather than simple routine. Furniture gets kept longer. Cars get driven past the point their owners once considered reasonable. None of this shows up as a dramatic headline on its own, but multiplied across millions of households that used to be the backbone of discretionary consumer spending, it quietly reshapes local economies, particularly the small businesses, contractors, and service providers who depended on confident, comfortable, middle-income spending that increasingly no longer exists in the way it once did. It is worth returning, at the end of this, to the household in the Dallas suburb, sitting at their kitchen table with $300 left before the next paycheck. Nothing about their situation will appear in a crisis report. No agency will count them among the officially poor, because they are not poor by any definition a government survey would recognize. They have a home, 2 incomes, 2 working cars, and healthcare coverage. And yet the feeling in that kitchen on a Sunday night is not the feeling of arrival that $100,000 was supposed to represent. It is the feeling of having done everything correctly and still being one bad month away from a very different life. That is the real shift hiding inside this story. Not that a six-figure income has become worthless, because it has not. It remains, by any honest national comparison, a genuinely strong income, one that the majority of American households would be grateful to have. What has changed is what that income is now required to absorb before a family gets to feel any of the confidence it used to guarantee. Housing, healthcare, and childcare have moved faster than wages for long enough that the number itself stayed the same while its meaning quietly eroded underneath it. The six-figure milestone did not disappear. It just stopped being able to promise what it once promised, and a growing number of Americans are only discovering that the first time they sit down, add it all up, and find far less room at the bottom of the page than the number at the top of their pay stub ever led them to expect.